Hello everyone, this is Matt Curfman with the Richmond Brothers here for the Matt's Minutes edition of June for 2019. Well, we just closed off the second quarter of the year, and for those of you in this area watching, there's probably going to be a lot of celebratory fireworks and things over the upcoming holiday weekend. So happy 4th of July to all of you. In the near term, the second quarter ended up being positive. The month of May was actually very choppy and actually went quite negative. That said, there's two or three things that are kind of hitting the headlines right now that are causing some of the choppiness, some of the uncertainty. One, as we've spoken on every single month this year, U.S. and China, tariffs, trade wars, that sort of topic. Just recently, they've called a quote truce, and the truce is just that they're back in the negotiating table. So the market had a little bit of a relief rally on the idea that U.S. and China had come back together to hopefully figure this out going forward. Still an uncertainty though, so I don't know that we can bake in, a win in that category yet. The Federal Reserve and interest rates continues to be an ongoing discussion on whether the Fed just stays paused at the current level or if they eventually lower the level. One of our concerns is if the Fed does start lowering the interest rates, because the economy has either slowed down, not growing as quick as it was, or because we're not seeing inflationary pressure, the federal funds rate is only so high, and if they start lowering and then in the next 1 or 2 years the economy tips into recession, it just doesn't give them much breathing room between 3% or 2.5% or 2% to keep dropping down to zero. When we went into the last recession, the Fed funds rate was in the ballpark of 6%. So they had a lot of flexibility to keep notching it down to make money cheaper to hopefully stimulate spending. So that's something we're paying close attention to. And then more recently, concern international over Iran and the drone and what implications that might have between the U.S. and Iran or other world powers. So those are some of the near-term things we're watching. When you look year-to-date, bonds are positive. The broad markets, the S&P 500, the Dow Jones, are in double-digit positive territory, but that doesn't mean it happens in a straight line. So by and large, we are seeing equity positions, if we isolate that part of your portfolio, definitely competing with, if not exceeding, what we're seeing in the broad markets. For those of you retired, keep in mind that your whole portfolio is very rarely, if ever, 100% in the market. So the market return is not our expected yield for the year, because we have some safety nets, some fixed income, some bonds and such to provide some safety and some stability. So as we keep moving through the year, I don't think our plan has changed. We want to continue whenever possible to keep pivoting in a position of strength from individual positions to much more broad-based holdings. So we're de-risking, and if I'm talking in risk-aligned language, an individual stock might be a 99, the broad market might be a 75, so getting to the S&P 500, QQQ, by and large aggregate bonds are in the mid-20s, and then money markets, CDs, fixed or fixed indexed annuities are all the way down at a risk level 1. So when we talk about shoring up safety nets in a position of strength, if ever possible, we want to skim off the top, balance the equity position, and shore up the bottom so that if we do tip into recession in the next 12 to 18 months, we've mitigated that risk greatly by skimming off the top along the way and ultimately going from a 99 in individual holdings down to 75 into the 50s, and then continuing to match up with your individual risk tolerance. So those are some of the things we're really looking at. Regulatory-wise, there is a proposal out there right now that's passed the House of Representatives. It's on the Senate floor now, but it's the Secure Act. And a couple of the key things, they're considering a proposal to change minimum distribution age from 70 and a half up to 72. And so what would that mean is it would also affect those of you who are doing qualified charitable distributions if you happen to be in that window. And again, I'll reiterate, this is a proposal, this is not law, but it's something we are paying attention to. It would potentially also eliminate the stretch IRA, which is if you inherit an IRA from a non-spouse, currently you get to stretch that over the remainder of your life expectancy. And the proposal has been put forth, and it's passed the House of Representatives, to take the stretch down to a 10-year payout. So if I'm 39 years old and I inherit an IRA from a non-family member, under current law, I could stretch that over the next 45, 46 years out into my 80s. Under the new law, if it does pass, I would have to have that all paid out and pay income tax on that if it were a pre-tax IRA over the next 10 years. So I think the government is in effect trying to have policies that might increase tax revenue. I think the reality, as most of us know, is those who inherit money don't always have the same ties to it as those who saved it. So we don't always see benefactors of retirement accounts trying to stretch it over their life. There are a good handful of individual investors who do take that long approach. But by and large, I don't think that will be a big revenue generator when it comes to increased taxes. So just a couple of things, and also many of you have now filed your taxes. A lot of retirees found that with the increased standard deduction and the lower tax rates, that we either broke even or some people even got a decent amount back. Not everyone, but by and large, if we're talking law of large numbers. So another thing to consider from a tax standpoint is Roth conversions are effectively on sale. If you can convert dollars that go to a Roth, that's taxable income to you. If rates are lower, you're paying less in taxes than you would have in previous years or forward years. And while the Roth would still have the inherited IRA rules of 10-year payouts, as long as you held them for 5 years and they were 59 and a half, the original owner, you would get that money back income tax free. So something to consider. And so as more and more of that comes out, we'll keep you up to speed. This summer is Richmond Brothers' 25th anniversary. John and Dave Richmond came together back in August of 1994 and formed what we all know now as Richmond Brothers Incorporated. I joined them in 97, so I've been here almost 22 of that 25 years. So keep watching out for some fun events and things that Kira and our marketing team have planned for the summer that we'd love you to take part in. If you have any questions, thoughts, comments, or concerns, as always, please feel free to reach out to us at questions@richmondbrothers.com. Thank you so much for tuning in and have a great continued summer.